You are listening to the CMQ Investing podcast, and in this episode, I'm going to read to you live the brand new letter to shareholders from Warren Buffett. It was just released today. We're also on Instagram Live right now through the Charlie Munger Quotes account. You know, I've done several episodes of the podcast that have been based around letters of the past, so it makes sense that we're reading this one as it happens, and I'm excited to do it with you guys. So let's begin, and I'll jump in with thoughts as I'm reading this too. I'm not just going to read this like an audiobook. To the shareholders of Berkshire Hathaway Incorporated, Charlie Munger, my longtime partner, and I have the job of managing a portion of your savings. We are honored by your trust. Our position carries with it the responsibility to report to you what we would like to know if we were the absentee owner and you were the manager. We enjoy communicating directly with you through this annual letter and through the annual meeting as well. Our policy is to treat all shareholders equally. Therefore, we do not hold discussions with analysts nor large institutions. Whenever possible, also, we release important communications on Saturday mornings in order to maximize the time for shareholders and the media to absorb the news before markets open on Monday. So that kind of explains why this letter is out on a Saturday. A wealth of Berkshire facts and figures are set forth in the annual 10K that the company regularly files with the SEC and that we reproduce on pages K1 through K119. Some shareholders will find this detail engrossing, others will simply prefer to learn what Charlie and I believe is new or interesting at Berkshire. Alas, there was little action of that sort in 2021. We did, though, make reasonable progress in increasing the intrinsic value of your shares. That task has been my primary duty for 57 years, and it will continue to be. It's a good reminder, too. You know, anyone that you're, any company you invest in, the manager or the top brass should be thinking that too. You know, what did he say here? He says, we've made reasonable progress in increasing the intrinsic value of your shares, and that has been my primary duty for 57 years. That's what you want from management, to increase the intrinsic value of your shares. Okay, this first section here is labeled What You Own. Berkshire owns a wide variety of businesses, some in their entirety, some only in part. The second group largely consists of marketable common stocks of major American companies. Additionally, we own a few non-U.S. equities and participate in several joint ventures or other collaborative activities. Whatever our form of ownership, our goal is to have meaningful investments in businesses with both durable economic advantages and a first-class CEO. Please note particularly that we own stocks based upon our expectations about their long-term business performance and not because we view them as vehicles for timely market moves. That point is crucial. Charlie and I are not stock pickers. We are business pickers. I like that. It's nice to see that. It continues. I make many mistakes. Consequently, our extensive collection of businesses includes some enterprises that have truly extraordinary economics, many others that enjoy good economic characteristics, and a few that are marginal. One advantage of our common stock segment is that, on occasion, it becomes easy to buy pieces of wonderful businesses at wonderful prices. That shooting fish in a barrel experience is very rare in negotiated transactions and never occurs en masse. It's also far easier to exit from a mistake when it has been made in the marketable arena. Surprise, surprise, that's the name of the next section. Here are a few items about your company that often surprise even seasoned investors. Many people perceive Berkshire as a large and somewhat strange collection of financial assets. In truth, Berkshire owns and operates more U.S.-based infrastructure assets classified on our balance sheet as property, plant, and equipment than are owned and operated by any other American corporation. That supremacy has never been our goal. It has, however, become a fact. At year-end, those domestic infrastructure assets were carried on Berkshire's balance sheet at $158 billion. That number increased last year and will continue to increase. Berkshire always will be building. Every year, your company makes substantial federal income tax payments. In 2021, for example, we paid $3.3 billion, while the U.S. Treasury reported total corporate income tax receipts of $402 billion. Okay, so Berkshire's almost responsible for 1% of total corporate income tax receipts. Interesting. Additionally, Berkshire pays substantial state and foreign taxes. I gave at the office is an unassailable assertion when made by Berkshire shareholders. Berkshire's history vividly illustrates the invisible and often unrecognized financial partnership between government and American businesses. Our tale begins early in 1955 when Berkshire Fine Spinning and Hathaway Manufacturing agreed to merge their businesses. In the request for shareholder approval, these venerable, did I say that right? It sounded like I said venereal. You know what? So I love reading these guys. They say words I don't know. Let me see how this is pronounced.
Venerable.
Venerable. All right. Thank you, producer. Let me just start that over. In the request for shareholder approval, these venerable New England textile companies expressed high hopes for the combination. The Hathaway solicitation, for example, assured its shareholders that the combination of the resources and managements will result in one of the strongest and most efficient organizations in the textile industry. That upbeat view was endorsed by the company's advisor, Lehman Brothers. Yes, that Lehman Brothers. I'm sure it was a joyous day in both Fall River, Berkshire, and New Bedford, Hathaway, when the union was consummated. After the band stopped playing and the bankers went home, however, the shareholders reaped a disaster. In the 9 years following the merger, Berkshire's owners watched the company's net worth crater from $51.4 million to $22.1 million. In part, this decline was caused by stock repurchases, ill-advised dividends, and plant shutdowns. But 9 years of effort by many thousands of employees delivered an operating loss as well. Berkshire's struggles were not unusual. The New England textile industry had silently entered an extended and non-reversible death march. I guess it's a good reminder to think about with certain companies. If they're on that extended and non-reversible death march, that'd be a good thing to have on an investing checklist. You know, is the company on an extended and non-reversible death march? And if the answer is yes, you do not invest. During the 9 post-merger years, the U.S. Treasury suffered as well from Berkshire's trouble. All told, the company paid only $337 million in income tax during that period, a pathetic $100 per day. Early in 1965, things changed. Berkshire installed new management that redeployed available cash and steered essentially all earnings into a variety of good businesses, most of which remained good through the years. Coupling reinvestment of earnings with the power of compounding worked its magic, and shareholders prospered. I really like that. Let's say that one more time. Coupling reinvestment of earnings with the power of compounding worked its magic, and shareholders prospered. Berkshire's owners, it should be noted, were not the only beneficiary of that course correction. Their silent partner, the U.S. Treasury, proceeded to collect many tens of billions of dollars from the company in income tax payments. Remember the $100 daily? Now, Berkshire pays roughly $9 million daily to the Treasury. In fairness to our governmental partner, our shareholders should acknowledge, indeed, trumpet, the fact that Berkshire's prosperity has been fostered mightily. Dude, he's using so many italics in this letter. It's ridiculous, dude. Buffett, fall back with the italics. The next 5 paragraphs, every paragraph has italics somewhere. So mightily is in italics. He goes, our prosperity has been fostered mightily because the company has operated in America. Our country would have done splendidly in the years since 1965 without Berkshire. Absent our American home, however, Berkshire would never have come close to becoming what it is today. It sounds like Buffett's kind of like petitioning for having to pay less taxes. Absent our American home, yeah. When you see the flag, say thanks. Now, I respect that, though. It's good to call that out. From an $8.6 million purchase of National Indemnity in 1967, Berkshire has become the world leader in insurance float. That is, money we can hold and can invest, but that does not belong to us. Including a relatively small sum derived from life insurance, Berkshire's total float has grown from 19 million, again italics, million, when we entered the insurance business to 147, and it's in italics, billion. So far, this float has cost us less than nothing. Though we've experienced a number of years when insurance losses combined with operating expenses exceeded premiums, here italics again, overall, we have earned a modest 55-year profit from the underwriting activities that generated our float. Of equal importance, float is very sticky. Funds attributable to our insurance operations come and go daily, but their aggregate total is immune from precipitous decline. When it comes to investing float, we can therefore think long term. To my surprise, our float increased $9 billion last year, a buildup of value that is important to Berkshire owners, though is not, again italics, not reflected in our generally accepted accounting principles, presentation of earnings, and net worth. Much of our huge value creation in insurance is attributable to Berkshire's good luck in my 1986 hiring, and I'm going to say his name wrong, of Ajit Jain. I'm sure that's so bad, I probably said that so wrong. We first met on a Saturday morning. We held hands under a park in Omaha and talked about our favorite songs and what our favorite cars were, and if we could ever see ourselves going on a road trip together across the country and doing nothing but staring in each other's eyes, even while I drive, which I know is dangerous, but I say, and again, this is in italics, but I love this man. Okay, none of that's real. Much of our huge value, sorry guys, I'm just having fun. We first met on a Saturday morning, and I quickly asked Ajit what his insurance experience had been. He replied, none. I said, nobody's perfect, and hired him. That was my lucky day. Ajit actually was as perfect a choice as could have been made. Better yet, he continues to be 35 years later. You know, if you worked for Warren Buffett and he stopped shouting you out, you would know he hates you, right? Because he just lavishes praise on people. If he stopped saying nice things, like, how come I wasn't in the letter this year? It's like, well, you probably want to pack up your desk. Clean out your desk, jackass. One final thought about insurance. I believe that it is likely, italics again, dude, Buffett, chill with italics, bro. I believe that it is likely, but far from assured, that Berkshire's float can be maintained without our incurring a long-term underwriting loss. Italics again coming up. I am certain, however, that there will be some years when we experience such losses, perhaps involving very large sums. Berkshire is constructed to handle catastrophic events as no other insurer, and that priority will remain long after Charlie and I are gone. All right, here's the part I'm looking forward to reading. 4 giants. Through Berkshire, our shareholders own many dozens of businesses. Some of them have a collection of subsidiaries of their own. For example, Marmon has more than 100 individual business operations, ranging from the leasing of railroad cars to the manufacture of medical devices. Nevertheless, operations of our big 4 companies account for a very large chunk of Berkshire's value. Leading this list is our cluster of insurers. Berkshire effectively owns 100% of this group, whose massive float value we described earlier. The invested assets of these insurers are further enlarged by the extraordinary amount of capital we invest to back up their promises. The insurance business is made to order for Berkshire. The product will never be obsolete, and sales volume will generally increase along with both economic growth and inflation. Also, integrity and capital will forever be important. Our company can and will behave well. There are, of course, other insurers with excellent business models and prospects. Replication of Berkshire's operation, however, would be almost impossible. Apple, our runner-up giant as measured by its year-end market value, is a different sort of holding. Here, our ownership is a mere 5.55%, up from 5.39% a year earlier. That increase sounds like small potatoes, but consider that each 0.1% of Apple's 2021 earnings amounted to $100 million. By the way, 100 million and the 0.1% were both in italics. We spent no, which is also in italics, we spent no Berkshire funds to gain our accretion. Apple's repurchases did the job. Repurchases, baby. It's important to understand that only, and this is in italics, only dividends from Apple are counted in the GAAP earnings Berkshire reports. And last year, Apple paid us $785 million of those. Yet our share of Apple's earnings amounted to a staggering 5.6, and this is in italics, billion. Much of what the company retained was used to repurchase Apple shares, an act we applaud. Tim Cook, Apple's brilliant CEO, quite prosperously regards users of Apple's products as his first love, but all of his other constituencies benefit from Tim's managerial touch as well. BNSF, our third giant, continues to be the #1 artery of American commerce, which makes it an indispensable asset for America as well as for Berkshire. If the many essential products BNSF carries were instead hauled by a truck, America's carbon emissions would soar. That's interesting. That's a Buffett way to kind of like flip the bird to the ESG crowd. Your railroad had earnings of $6 billion in 2021, and here it should be noted, we are talking about the old-fashioned sort of earnings that we favor, a figure calculated after interest, taxes, depreciation, amortization, and all forms of compensation. Our definition suggests a warning. Deceptive adjustments to earnings, to use a polite description, have become both more frequent and more fanciful as stocks have risen. Speaking less politely, I would say that bull markets breed bloviated bull. Say that again. I would say that bull markets breed bloviated bull. I like that. BNSF trains traveled 143 miles last year and carried 535 million tons of cargo. Both accomplishments far exceeded those of any other American carrier. You can be proud of your railroad. She's also saying that. I'm so proud of my railroad right now, guys. I'm so proud of my railroad, my treasury. Okay, ongoing to another one of the four giants. BHE, our final giant, earned a record $4 billion in 2021. That's up more than 30-fold from the, here we go, italics, $122 million earned in 2000, the year that Berkshire first purchased a BHE stake. Now Berkshire owns 91.1% of the company. BHE's record of societal accomplishment is as remarkable as its financial performance. The company had no wind or solar generation in 2000. It was then regarded simply as a relatively new and minor participant in the huge electric utility industry. Subsequently, under David Sokol's and Greg Abel's leadership, BHE has become a utility powerhouse and a leading force in wind, solar, and transmission throughout much of the United States. Greg's report on these accomplishments appears on page A3 and A4. The profile you will find there is not in any way one of those currently fashionable greenwashing stories. I love Buffett, man. BHE has been faithfully detailing its plans and performance in renewables and transmission every year since, here we go, italics again, every year since 2007. To further review this information, visit BHE's website at brkenergy.com. There you will see that the company has long, that was italics as well, has long been making climate-conscious moves that soak up, italics again, all of its earnings. Dude, Buffett, chill with the italics, bro. Just chill. More opportunities lie ahead. BHE has the management, the experience, the capital, and the appetite for the huge power projects that our country needs. Next up, investments. Now let's talk about the companies that we don't control. A list that again references Apple. Below, we list our 15 largest equity holdings, several of which are selections of Berkshire's two longtime investment managers, Todd Combs and Ted Weschler. At year-end, this valued pair had total authority in respect to $34 billion of investments, many of which do not meet the threshold value we use in the table. Also, a significant portion of the dollars that Ted and Todd manage are lodged in various pension plans of Berkshire-owned businesses, with the assets of these plans, italics, not included in this table. Okay, so they have American Express. It's about 20% of the company that they own. Apple, we mentioned. Bank of America, they own 12.8%. The Bank of New York Mellon Corp, 8.3%. BYD, we've talked about that in the podcast. They own 7.7%. Charter Communications, 2.2%. Chevron, 2%. Coca-Cola, 9.2%. General Motors, 3.6%. I don't know what this is, ITOCHU. I need to look that up. They own 5.6%. They own 5.5% of Mitsubishi, 5.7% of Mitsui & Co., 13.3% of Moody's, 9.7% of U.S. Bank Corp., and 3.8% of Verizon. Can you hear me now? Good. In addition to the footnoted Occidental holding in our various common stock positions, Berkshire also owns a 26.6% interest in Kraft Heinz, accounted for on the equity method, not market value, and carried at $13.1 billion. And additionally, they have 38.6% of Pilot Corp., which is a leader in travel centers that had revenues last year of $45 billion. Since we purchased our Pilot stake in 2017, this holding has warranted equity accounting treatment. Early in 2023, Berkshire will purchase an additional interest in Pilot that will raise our ownership to 80%, and lead to our fully consolidating Pilot's earnings, assets, and liabilities in our financial statements. Moving on to the next section, which is titled U.S. Treasury Bills. Berkshire's balance sheet includes $144 billion of cash and cash equivalents, excluding the holdings of BNSF and BHE. Of this sum, $120 billion is held in U.S. Treasury bills, all maturing in less than a year. That stake leaves Berkshire financing about 0.5% of the publicly held national debt. Charlie and I have pledged that Berkshire, along with our subsidiaries other than BNSF and BHE, will always hold more than $30 billion of cash and equivalents. We want your company to be financially impregnable and never dependent on the kindness of strangers, or even that of friends. Both of us like to sleep soundly, and we want our creditors, insurance claimants, and you, which is in italics, to do so as well. By the way, I've never heard the word impregnable used other than in boxing. Mike Tyson once said that his defense is impregnable. He's like, I think it was before he was going to fight Lennox Lewis when he said he was going to eat his children. I want to eat his children. Mike Tyson. I could do a little Mike Tyson for you guys. He was like, I'm the most ferocious. My defense is impregnable. I want to eat his children. And then he went, and swear to God, he went, and praise be to Allah. That's what Mike Tyson said after a fight. I'm just relaying the message, guys. It was a really great. I should pull that up. Maybe you could put that in there. Oh, my God. Mike Tyson, man, what a legend. Great podcast, by the way. Hot Boxing with Mike Tyson. Check that out. Okay, he said he wants us to sleep well at night. But $144 billion? That imposing sum, I assure you, is not some deranged expression of patriotism. Nor have Charlie and I lost our overwhelming preference for business ownership. He said business in italics again. Indeed, I first manifested my enthusiasm for that 80 years ago on March 11th, 1942, when I purchased 3 shares of Citi Services preferred stock. Their cost was $114.75, and it required all, which is in italics, all of my savings. The Dow Jones Industrial Average that day closed at 99, a fact that should scream to you, never, in italics, never bet against America. Can we get a little USA chant going? A little USA! After my initial plunge, I always kept at least 80% of my net worth in equities. My favored, again, italics, dude, Buffett, chill, bro. My favored status through that period was 100%, and still is. Berkshire's current 80 or so position in businesses is a consequence of my failure to find entire companies or small portions thereof, that is, marketable stocks, which meet our criteria for long-term holding. Charlie and I have endured similar cash-heavy positions from time to time in the past. These periods are never pleasant. They are also never permanent. Unfortunately, we have had a mildly attractive alternative during 2020 and 2021 for deploying capital. Read on. Okay, so just for those of you who are joining, those of you who are listening as a podcast, where I think things are about to go right now is he's going to explain why, since they can't find anything that looks good to buy or buy a piece of, they've instead used money to buy back shares of Berkshire, which I imagine they believe are undervalued. So this next section is called share repurchases. There are 3 ways that we can increase the value of your investment. And by the way, as shareholders of any business, this is what you want to hear from management. Like, this is what their job is. You're not giving them money to just give them money. Like, their duty is to go out there and create and maximize shareholder value. At least I believe that. So he says there are 3 ways that we can increase the value of your investment. The first is always, italics, always front and center in our minds. Increase the long-term earning power of Berkshire's controlled businesses through internal growth or by making acquisitions. Today, internal opportunities deliver far better returns than acquisitions. The size of those opportunities, however, is small compared to Berkshire's resources. Our second choice is to buy non-controlling part interests in the many good or great businesses that are publicly traded. From time to time, such possibilities are both numerous and blatantly attractive. Today, though, we find little that excites us. That's largely because of a truism. Long-term interest rates that are low push the prices of all productive investments upward, whether these are stocks, apartments, farms, oil wells, whatever. Other factors influence valuations as well, but interest rates will always be important. Our final path to value creation is to repurchase Berkshire shares. Through that simple act, we increase your share of the many controlled and non-controlled businesses that Berkshire owns. When the price to value equation is right, this path is the easiest and most certain way for us to increase your wealth. Alongside the accretion of value to continuing shareholders, a couple of other parties gain. Repurchases are modestly beneficial to the seller of the repurchased shares and to society as well. Periodically, as alternative paths become unattractive, repurchases make good sense for Berkshire's owners. During the past 2 years, we therefore repurchased 9% of the shares that were outstanding at year-end 2019 for a total cost of $51.7 billion. That expenditure left our continuing shareholders owning about 10% more of all Berkshire's businesses, whether they are wholly owned, such as BNSF and Geico, or partly owned, such as Coca-Cola and Moody's. It's kind of interesting. It makes me think a little bit about how I'm probably overexposed to Apple, not just through index funds, but through Berkshire. I want to underscore that for Berkshire's repurchases to make sense, our shares must offer appropriate value. We don't want to overpay for the shares of other companies, and it would be value destroying if we were to overpay when we are buying Berkshire. And that's interesting because Berkshire, again, it's a conglomerate. It owns hundreds and hundreds of businesses. And so, one of the ways that Buffett and Munger and the team have gone about acquiring those businesses is to always make sure that there's a good balance, or I should say there's a good opportunity there between price and value. There's a margin of safety. So if you decide just to rush to buy back shares and you're buying back shares of your company for, let's say not their appropriate value, it's really self-defeating, right? So Buffett says, as of February 23rd, 2022, since year-end, we repurchased additional shares at a cost of $1.2 billion. Our appetite remains large, but will always remain price-dependent. It should be noted, and I should say this before he says what he says, it's just a good reminder, like, these guys have been in the game for a long time, and one thing they've never done, or they've worked, I shouldn't say never, because you never want to say never or always, but let's just say never. They've never overpaid for something, and that's doesn't guarantee you're going to be Buffett, but it keeps you out of trouble. It also puts you in the right mindset as someone who's buying a business, not someone who's buying a little, a ticker symbol to watch it go up or down. You're buying a business. So if you're buying the entire business, the dumbest thing you could do is overpay. It should be noted that Berkshire's buyback opportunities are limited because of its high-class investor base. If our shares were heavily held by short-term speculators, both price volatility and transaction volumes would materially increase. That kind of reshaping would offer us far greater opportunities for creating value by making repurchases. Nevertheless, Charlie and I far prefer the owners we have, even though their admirable buy-and-keep attitudes limit the extent to which long-term shareholders can profit from opportunistic repurchases. Finally, one easily overlooked value calculation specific to Berkshire. As we've discussed, insurance float of the right sort is of great value to us. As it happens, repurchases automatically increase the amount of float per share. That figure has increased during the past 2 years by 25%, going from 79,387 per A share to 99,497, a meaningful gain that, as noted, owes some thanks to repurchases. Next section here, and we're getting to the end. A wonderful man and a wonderful business. Last year, Paul Andrews died. Paul was the founder and CEO of TTI, a Fort Worth-based subsidiary of Berkshire. Throughout his life, in both his business and his personal pursuits, Paul quietly displayed all the qualities that Charlie and I admire. His story should be told. In 1971, Paul was working as a purchasing agent for General Dynamics when the roof fell in. After losing a huge defense contract, the company fired thousands of employees, including Paul. With his first child due soon, Paul decided to bet on himself, using $500 of his savings to found Textronics, later renamed TTI. The company set itself up to distribute small electronic components, and first-year sales totaled $112,000. Today, TTI markets more than 1 million different items with annual volume of $7.7 billion. But back to 2006, Paul, at 63, then found himself happy with his family, his job, and his associates. But he had one nagging worry, heightened because he had recently witnessed a friend's early death and the disastrous results that followed for the man's family and business. What, Paul asked himself in 2006, would happen to the many people depending on him, italics, him, if he should unexpectedly die? And he said, I better sell my company to Warren Buffett for a discount. I'll let that one sit for a sec. As Paul thought about an irrational fear, Warren Buffett swooped in and took advantage of that irrationality. For a year, Paul... Sorry, guys. Look, Buffett's an opportunist, right? So, of course, he would know that. For a year, Paul wrestled with his options. Sell to a competitor? From a strictly economic viewpoint, that course made the most sense. After all, competitors could envision lucrative synergies, savings that would be achieved as the acquirer / duplicated functions at TTI. But, such a purchaser would most certainly also retain its CFO, its legal counsel, its HR unit. Their TTI counterparts would therefore be sent packing. If a new distribution center were to be needed, the acquirer's home city would certainly be favored over Fort Worth. Whatever the financial benefits, Paul quickly concluded that selling to a competitor was not for him. He next considered seeking a financial buyer. A species once labeled, aptly so, a leveraged buyout firm. Paul knew, however, that such a purchaser would be focused on an exit strategy, and who could know what that would be? Brooding over it all, Paul found himself having no interest in handing his 35-year-old creation over to a reseller. When Paul met me, he was desperate. He was dressed in shabby clothes. I approached him. I said, my name is Warren Buffett. You look like you need help, little guy. He said, I do. I'm scared to death of my death and what it'll do to my family. I replied, sell me your company for a discount. Do it now. He said, can I talk to a lawyer? I said, we don't do lawyers. My name is Warren Buffett. You do what I say now. He sold me the company. I made him a consultant and paid him $50,000 a year for the rest of his life. None of that's true. All right, sorry guys. See, I sort of got humor is how I got myself through learning this stuff, because some of it's just like. Meanwhile, at the investing class, when Paul met me, he explained why he had eliminated those two alternatives as buyers. So basically, Paul already showed his hand when he met Warren Buffett. He's like, I'm not going to sell to these two. I'm not going to go either of these two paths. So you're all I got, buddy. Like, terrible negotiation. He explained he had eliminated these alternatives. Okay. He then summed up his dilemma by saying, in a far more tactful rephrasing than this, after a year of pondering the alternatives, I want to sell to Berkshire because you're the only guy left. Holy shit, dude. You don't say that. What? So I made an offer and Paul said yes. One meeting, one lunch, one deal. That's literally, dude, Buffett's just flexing right now. Warren, I know you've been known to be really generous and overpaying for things and just making sweetheart deals for business owners like myself. So I want to sell to you. Didn't even bring his lawyer. Come on, man. No wonder Buffett loves this guy. He's like, I'm going to tell you about a little sucker I know named Paul. He's my favorite sucker. To say we both lived happily ever after is an understatement. When Berkshire purchased... Here we go, guys. This is great. I'm glad. This is why I wanted to do this live. When Berkshire purchased TTI, the company employed 2,387 people, and now that number is 8,043. A large percentage of that growth took place in Fort Worth and environs. Earnings have increased 673%. Annually, I would call Paul and tell him his salary should be substantially increased. Annually, he would tell me, we could talk about that next year, Warren. I'm too busy now. What? When Greg Abel and I attended, I'm sorry, by the way, I know this person is deceased, and I'm not making fun of him, actually. It's just, we're trying to keep this light. But yeah, what he's going to say here is what's kind of like changing my tone. When Greg Abel and I attended Paul's memorial service, we met children, grandchildren, longtime associates, and John Roach, the former CEO of a Fort Worth company that Berkshire had purchased in 2000. John had steered his friend Paul to Omaha, instinctively knowing we would be a match. At the service, Greg and I heard about the multitudes of people and organizations that Paul had silently supported. The breadth of his generosity was extraordinary, geared always to improving the lives of others, particularly those in Fort Worth. In all ways, Paul was a class act. Now, all jokes aside, it's cool that Warren Buffett pays tribute to him here, and certainly, makes his name much bigger, and in a way, kind of makes him immortalizes him by putting him in one of his letters. So all jokes aside, obviously I wasn't thinking about this a real person who passed away and left behind family and things like that, but you guys know where my heart is. Good luck, occasionally extraordinary luck, and extraordinary is in italics, has played its part at Berkshire. If Paul and I had not enjoyed a mutual friend, John Roach, TTI would not have found its home with us. But that ample serving of luck was only the beginning. TTI was soon to lead Berkshire to its most important acquisition. Every fall, Berkshire directors gather for a presentation by a few of our executives. We sometimes choose the site based upon the location of a recent acquisition. By that means, allowing directors to meet the new subsidiary's CEO and learn more about the acquiree's activities. In the fall of 2009, we consequently selected Fort Worth so that we could visit TTI. At the time, BNSF, which also had Fort Worth as its hometown, was the third largest holding among our marketable equities. Despite that large stake, I never visited the railroad's headquarters. Okay, yeah, we said Deb Bosnick, my assistant, scheduled our board's opening dinner for October 22nd. Meanwhile, I arranged to arrive earlier that day to meet with Matt Rose, CEO of BNSF, whose accomplishments I had long admired. When I made the date, I had no idea that our get-together would coincide with... Okay, no one gives a shit, Warren. The market reacted... like, thanks, Warren. Can you just wrap it up, buddy? Okay, we don't care about any of this. Thanks. Now he says thanks. All right, so, I mean, that's pretty much the gist of it, guys. The rest of it's... I think you should probably take a time to read, but I don't think it'd be that entertaining for you to hear me read it. We got through most of the meat. I see a lot of hearts right now, so I assume that means the feeling is mutual. I'm also going to write a letter of my own, the CMQ Investing letter to shareholders, where I antagonize Warren Buffett for writing a letter with so many italics, because it really is, it's unprofessional. It's not a good example of how to use the English language, or at least the written word. And I think he should be ashamed of himself. Generally, Warren Buffett is extremely overrated. And someone asked, do you know if the new Li Lu book is out in English? No, I read it in Chinese. No, yeah, of course it is. What book are we talking about? I prefer to read the Alibaba 10K in Chinese. I don't understand it, but I feel like I'm closer to the company. Okay, CMQ investors, that's the show. I just want to say a couple things really quick before we go here. For those of you who've not listened before, you might not realize or have a sense of my sense of humor. It can be dry at times and sarcastic, but I mean no disrespect, obviously, to Warren Buffett. I've learned so much from him. He is the GOAT. On other news or other notes here, I just want to say if you haven't already followed the podcast on Apple Podcasts or Spotify, if you could go ahead and do that, it is in your interest. You will get every new episode in your feed as soon as it's released. That's always a good thing because I'm releasing multiple episodes every week. I don't want to promote anything else. I just want to say thank you for listening. Thank you for supporting. Thank you for sharing. I appreciate it a lot. I think we're really building something cool here. So thank you for being part of it. And on that note, once again, this is the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.